When we talk about a retirement fund, we picture something simple, almost childlike. A piggy bank of sorts. You save through your working years, the bank safeguards it, and when the time comes, you crack it open and take what you've earned. At least, that's the comforting myth we're sold.
Yeah, but step into the world of institutional pensions spanning decades, and that piggy bank is actually a really complex, multi layered vault with a combination lock, and everyone holds a different number to the lock, but no one has the whole lock combination.
Right? And that is exactly the crisis. Hiding inside this staggering 4.57 lakh crore rupee pension fund right now,
It's huge.
it really is. So, welcome to today's deep dive. We're unpacking a detailed letter from G.V Subba Ramaiah, a retired bank senior branch manager, and our mission today is to cut through the legal jargon.
And, explore the hidden financial tug of war within that fund.
Welcome to the Bloggerian, the trusted source for pensions and personal finance. It's a privilege to have you here.
If this channel helps you understand what's happening in the financial services space, I'd be honored if you'd hit that subscribe button and join our growing community of informed viewers.
Now, have you ever noticed how seemingly simple demand for fairness usually hides a much messier reality? This deep dive is basically a masterclass in how complex institutions handle and mishandle superannuation and pensions.
The conflict really starts with what the petitioners are demanding in court right now. I mean, nearly 7.5 lakh pensioners have waited 25 years for pension updation.
Wow, 25 years.
Yeah, and they want their payouts revised using the RBI formula.
So they're basically looking at that 4.57 lakh core fund, seeing inflows outpace outflows, and thinking, well, the collective bank account is full.
Right? Time to start writing the checks.
Yeah, exactly.
And then comes the reality check from G.V Subba Ramaiah, a former senior Bank of Baroda manager. He doesn't mince words. He argues that beneath all the noise are hidden traps, pitfalls retirees are walking past without even noticing.
Like what?
Well, first, pending court cases. I mean, if those land in favor of other petitioners, that triggers massive outflows that could drain the fund completely. You just can't spend money today that you might legally owe someone else tomorrow.
Right, which is just basic accounting.
And here's the part that stings. Nearly 4 lakh pensioners are being underpaid, anywhere from 7.75% to 31.5%, all because of a special allowance anomaly the banks engineered to shrink the basic pay used for pension calculations. It wasn't an accident, it was a design.
Wait, really? That much?
Yeah, it flat out violates the 95 bank employees pension regulations, so the baseline is already broken.
And the reason that baseline is so broken goes back to, well, a massive structural mistake from a decade ago. It's basically generational warfare at this point.
Generational warfare is a good way to put it, yeah. Different eras of bank retirees were handed wildly unequal deals.
Right.
Take the retirees from 1997 to 2007, for example. Banks were actively trying to downsize then, so they offered what the author calls a golden shake hand to retiring staff.
Oh, like the sweet early retirement deals.
Exactly, tax exemptions on superannuation plus 5 years of salary and their pension from month one.
Man, they got an incredibly good deal to leave early.
They really did. But then look at the group from 2010, the so called second option pensioners.
Right, the ones who had to join the scheme late.
Yeah, to join late, they were forced to pay staggering premiums just to cover the massive deficit those early retirees created.
I mean, we are talking huge numbers here. Retirees in 2010 had to pay a 56% premium, and active employees had to pay up to 156% extra just to buy in.
Which is incredible. They were essentially bailing out the fund. In fact, that 2010 group brought in more than 2/3 of the current pension pool.
Hold on, if that second group practically built the entire fund with their massive premiums, applying the RBI formula across the board to pay out huge arrears to everyone else is just, well, it's looting the 2010 guys to pay the 1997 guys. Totally indistinguishable from a Ponzi scheme.
That is exactly what the author points out.
It's like the early guests at a dinner party ate a 5-course meal for free. The late arrivals were handed the bill for the whole table. And now the early guests are demanding dessert.
That is the perfect analogy. The author actually calls the demand for these arrears unimaginable greed.
Unimaginable greed, wow.
Yeah, because it would wipe out the entire fund. Giving an across-the-board RBI-style bump destroys the very people who capitalized the pool in the first place.
So if a court-mandated RBI formula destroys the fund mathematically, what is the actual, viable alternative here?
Well, G.V Subba Ramaiah outlined a really transparent compromise. First, keep it out of the courts. Just exhaust the existing negotiation mechanisms between the unions and the banks.
Because judicial mandates often ignore the underlying math of the fund, right?
Right, exactly. Courts look at the law, not always the actuarial reality.
So negotiate first. But what is the mathematical fix they propose?
Merge the dearness allowance, or DA, with basic pensions as of November 1st, 22. By rolling that inflation adjustment directly into the base pension, you effectively recalculate the baseline payout.
Okay, so everyone gets 50% of their DA-bearing components.
Yes. This puts all generations on an even footing regarding inflation rather than applying a blanket multiplier that, disproportionately rewards the early retirees.
Right, that handles the baseline anomaly. But what about the 2010 group? The ones who footed the bill for the whole dinner party?
G.V Subba Ramaiah proposes that if the fund truly is in surplus, like the petitioners claim, then the only mathematically fair move is to refund the excess premiums.
The ones collected from those second option pensioners?
Exactly, and with appropriate interest.
That makes a lot of sense. You fix the structural math of the inflation payouts for everyone, and then you refund the capital to the people who actually overpaid to build the vault.
Right? It honors the actual source of the money while stabilizing the future payouts. It's a solution rooted in the actual math, not just optics.
Yeah, it really leaves you with something to mull over. Think about the institutions you rely on. When a collective fund is built using drastically different staggered buy-in costs across different eras, is it ever truly a collective fund?
That is the big question.
Right? Or is it just a ticking time bomb of competing investments? Next time you look at that retirement piggy bank, ask yourself, who else has a key and what did they actually pay for it?
Thank you for watching. We really feel privileged to have you as an audience. Please subscribe, like, comment, and share. Catch you again soon.